The European banking crisis has brought back the spotlight on the pecking order of debt repayment. The decision to write off $17 billion in AT1 bonds issued by Credit Suisse is reminiscent of a similar incident in India a few years ago with the Yes Bank. Today, we have with us Dr. Harsh Vardhan, an independent researcher in finance and banking, to share some insights on how both the global banking crisis situations unfolded. Hi Harsh. So can you please tell us a little bit more about the AT1 bonds?
Yes. So the term AT1 stands for additional tier 1 bonds. Before I explain what that is, you have to understand what capital is and why it is so important in banking. So capital, as we all know, is equity capital. It's the owner's stake in any business. The same thing is true for banks as well. So whatever is the owner's capital in bank is called capital. But in banks, there is a very important additional role that capital performs, which is that the regulators describe a minimum level of capital that the banks have to hold. And that minimum level is described on the basis of the amount of loans that the banks make.
Right.
And this is done in order to keep the bank safe for the depositors, because depositors have given their money to the bank from which the bank makes loans, and those depositors have to be therefore safe. Their money has to be safe. So the regulators prescribe that the banks must maintain a certain minimum level of capital. Now, normally this capital is in the form of owner's capital, equity capital. However, because banks need a lot of capital as they grow, as their loan business grows, banks have been given the permission to use some other forms of capital, which is not the equity capital of the shareholders. One such form is called additional tier 1, which is nothing but a bond. Remember, bond is a debt instrument.
Right.
It's like money borrowed from some other debt holders, which then counts as capital. And why it counts as capital? Because in the banking system, the most important characteristic of anything that counts as capital is its ability to absorb losses. So when bank gets into trouble, makes a lot of losses, then there is something that has to absorb those losses before depositors get hurt. It's a bit like airbags in a car. What do airbags do? That in the event of a crash, they protect the passengers by buffering the impact. That is exactly what a capital is supposed to do. So banks are allowed to raise some type of bonds as capital, and the most important of those type of bonds are called AT1 bond, additional tier 1 bond. So bank capital is divided into 3 types: core equity, which is the normal capital of shareholders; tier 1, which is these AT1 bonds; and then there is tier 2, which are some other type of bonds.
Right.
Now the difference between this thing is that these 3 types of capital is that in the event of losses, there is a certain pecking order in which the losses are attributed to this. And that pecking order is, first you give losses to the equity holders, then to AT1 bond holders, and then to AT2 bond holders. So there, if I remember, I told you about the airbags. So the impact that losses have on a bank goes in stages. That's at least how the investment world understands this bank to be. There is a certain pecking order of absorbing losses. So those are what are AT1 bonds. They are after equity in terms of their losses absorption, but before tier 2 bonds.
The Credit Suisse banking crisis has once again brought back the spotlight on AT1 bonds, which were widely debated in the case of Yes Bank as well. Can you tell us a little bit about how these bonds work during such crisis?
Sure. So both these examples, Yes Bank crisis happened about a couple of years ago, and Credit Suisse about a couple of weeks ago, where situations where basically this bank ran into significant losses. And as I said, the impact of that could be depositors who have given money should not be impacted by these losses. That's the primary objective of any banking regulator. And so the capital has to absorb these losses. Now what happened in both Yes Bank case and in Credit Suisse case, if remember I told you about the pecking order of absorption losses,
right.
First equity, then AT1 bonds,
right.
That order was not followed.
Okay.
So without first writing down the common shareholders equity, which is the first line of defense, so to say, the regulators allowed the AT1 bonds to be written down. By written down meaning their value became 0. So if you are an investor, you are holding $100 worth of bond, their value overnight becomes 0. And that was done before similar thing was done to equity holders. And that is what went against investors' expectations. Now bear in mind, it was strictly, legally speaking, it was right in the sense that the regulators had the authority to do so. Both in India as RBI and in Credit Suisse case, Swiss National Bank, which is regulator there. However, it went quite totally against how investors actually view these instruments. And so there was a bit of a shock. What happened therefore in India is that the bondholders, the AT1 bondholders went to court, Bombay High Court, saying that look, this is not done. This is not how we expect these bonds to be treated. The Bombay High Court actually ruled in favor of them, but not on the underlying principle of this pecking order, but on some technical grounds, some process lapses that were that day the court said happened. And so the bank has now gone to Supreme Court where the matter will be heard. I am absolutely sure that in case of Credit Suisse also this matter will be litigated in European courts. Bear in mind, Credit Suisse had $17 billion or so of these bonds outstanding.
Right.
The total European market is 275 billion.
Okay.
If that whole bond are written down or lose significant value, that's a substantial loss to investors. Absolutely. So it's a very serious economic issue. Depending on where the courts ultimately rule on this will decide the fate of these banks. If the underlying principle is not established that these banks cannot be written down before equity, then basically investors will start treating these banks like equity, which means their returns expectations will increase. Remember, equity returns are the highest.
Correct.
Which also will mean that their value for the outstanding bonds, the value will fall, and for the future issuance it will become much more expensive for the banks. So very important source of capital could become significantly more expensive for the banks should the courts not rule to establish the pecking order as is expected. It's also important to keep in mind that other banking regulator, the Bank of England, the Monetary Authority of European Central Bank and Monetary Authority of Singapore, all have come out with public statement strongly endorsing the pecking order and saying that they will in their jurisdictions actually follow that order, which tells you that this is a fairly serious matter.
Correct. Okay, great. Thanks, Harsh, for this insightful chat.